If you think gold is supposed to rise every time the world gets more dangerous, you are already standing in the wrong classroom. You were taught the children. S version, war starts, fear rises, gold jumps. Simple, clean, reassuring. And when reality breaks that sequence, most people do not change the model. They panic. They say the safe haven failed. They say the thesis is broken. They say the market no longer makes sense. That is where weak hands get separated from patient hands, because the first phase of a real monetary shock is often not safety. It is liquidation. It is collateral stress. It is margin. It is forced selling. It is the strong dollar eating the weak holder before the long-term thesis even gets a chance to breathe. That is where I want to begin, not with a slogan, with the mechanism, because the mechanism is what saves you. If you want the mother line for everything I am about to tell you, here it is. Gold does not get crushed in moments like this because the long-term case for gold disappears. It gets crushed because the paper market, the dollar, margin rules, sovereign liquidity needs, and institutional positioning can combine to force weak holders out of the trade right before stronger hands. Central banks and patient buyers start pulling real metal in the other direction. That is the line. Read it again, because once you understand it, you stop asking the wrong question. You stop asking, why didn't T-gold behave the way the textbook said? You stop asking, did the safe haven fail? You stop asking, should I trust the headline price by itself? You start asking the adult question, who is being forced to sell paper claims, who still needs immediate dollars, and who is quietly taking possession of the actual metal, while the public stares at the chart? That is the real question. That is the profitable question. That is the question most people never ask because they are too busy reacting to the move instead of decoding the structure that created it. I learned a long time ago that the price shown to the public and the reality experienced by the strongest players are often not the same thing. That is not conspiracy language. That is market structure. A market can show weakness on the screen while strength is building underneath it. A market can show strength on the screen while the structure is rotting underneath it. The screen is not the whole truth. It is one layer of the truth. And in gold, that distinction matters more than almost anywhere else, because the market most people think they are watching is often not the market that actually governs who will own the metal when confidence in paper gets thinner. Now let me say something harder. A lot of people own gold emotionally before they understand gold structurally. That is why they suffer. They understand the story of gold. They do not understand the plumbing. They understand inflation. They do not understand margin. They understand safe haven language. They do not understand how the dollar can become the short-term winner even while the long-term monetary case for gold becomes stronger. That ignorance is expensive, because if you do not understand the plumbing, every violent move feels like betrayal. Nothing useful gets built from that state. Now let me take you into the first mechanism. I call it the paper price illusion. Most people think the gold price is the price of gold. Too simple. The source material makes this point over and over. It says the price most people see is usually the COMEX futures price, that each contract represents 100 ounces, and that only a small fraction of contracts actually settle with physical metal changing hands. The rest are mostly directional paper claims. That is the paper price illusion. And if you do not understand it, the rest of the story stays blurry. A market dominated by paper claims can set the visible price without requiring an equal movement of real bars into real hands. That matters, because it means the chart can be driven by leverage, margin, and positioning far more aggressively than most ordinary buyers of coins or bars. Imagine a futures market is not evil by definition. It is simply a different animal. It is a market for exposure, not a market where every buyer is taking delivery and every seller is handing over bullion. And once you understand that, you stop using the word gold lazily. You start asking whether you mean physical ownership, paper exposure, futures positioning, ETF flows, central bank accumulation, vault inventory, or simply the quote, a news anchor put on the screen. Those are related. They are not identical. This is one of the oldest mistakes in commodity investing. People think one number can summarize the entire structure. It cannot. The source material even tries to dramatize this by saying the paper market is largely setting price while the physical market can be telling a very different story underneath. Strip away the theatrical language and the structural point is still useful. Paper can dominate the visible quote even when physical behavior is shifting in another direction. That is exactly right. A person who confuses the public quote with the entire market is one headline away from emotional stupidity. A person who understands that the quote is only one layer of a more complex machine can remain much calmer. That calm matters because the public is usually invited into the chart late and shaken out of the chart early. The stronger hands care less about the visible drama and more about the transfer of ownership happening beneath it. That is the paper price illusion. Now let me take you into the second mechanism. I call it the margin hammer. This is where the public gets punished hardest, because this is where a move stops being a thesis question and becomes a survival question. The source material is very clear here. It says the CME changed the margin framework, so requirements rose as contract values rose, then tightened again several times in rapid succession, creating a structure in which rising gold prices automatically increased the collateral burden for long holders. It then describes the predictable result. Forced selling cascades as smaller players cannot meet margin calls. That is the margin hammer. And it is one of the most brutal ways to flush a market, not because it proves the underlying thesis wrong, because it proves the holder too weak for the path. That is an enormously important distinction. A person can be right about gold for the next 5 years and still get destroyed this week if the position is built on leverage and the exchange changes the carrying cost at the wrong moment. That is why I have always told people the path matters almost as much as the destination. If your structure cannot survive the path, your eventual correctness becomes irrelevant. The margin hammer punishes that error fast. A gold bull with no leverage and no forced collateral obligation experiences a very different week from a gold bull who is carrying futures exposure through an exchange that is suddenly demanding more money. Same opinion, different structure, different outcome. That is what the public fails to respect. They think the market turned against gold. Often it turned against a certain class of holder, a weak holder. An overextended holder, a holder who needed the price to behave immediately, instead of eventually. The source material keeps repeating that the margin hikes hurt smaller traders and weaker hands far more than giant banks or institutions with deep balance sheets. That is exactly what one should expect from such a mechanism. Yes, the strong can absorb a storm and wait. The weak have to sell into it. That is the oldest trick in markets. Shake the weak hands out, buy what they are forced to drop, then let the narrative catch up later. This is why I tell people not to confuse being bullish with being prepared. A lot of people were bullish. Very few were prepared. The margin hammer teaches the same lesson every cycle. If you do not own your position in a way that lets you survive a disorderly flush, then you do not really own the position. The position owns you. Now let me take you into the third mechanism. I call it the dollar squeeze. This is the part that humiliates the people who rely on slogans. They say war means gold up. Too neat. The actual chain can be much rougher. The source material lays out the sequence in its own way. War pushes oil higher. Higher oil feeds inflation. Fears inflation makes the Fed less likely to cut. Higher for longer rates support a stronger dollar, and a stronger dollar becomes a headwind for gold in the short run, especially for non-dollar buyers. That is the dollar squeeze. And if you do not understand it, you will keep treating contradiction as if it were proof of manipulation alone, when often it is also the natural sequence of a stressed monetary hierarchy. The world gets more dangerous. People want safety. They run not only to gold but also to dollars and dollar debt because the dollar remains the operating currency of much of the system. That short-term dollar demand matters. A stronger dollar raises the local currency cost of gold for foreign buyers. That can soften demand right when the public expected the opposite. This is not a philosophical statement about whether the dollar deserves that role forever. It is a structural statement about how the system behaves right now. The source material says this explicitly too. Safe haven flows into the dollar, combined with rates staying higher, create a feedback loop that strengthens the dollar and pressures gold. That is not irrational, it is hierarchical. First, the market seeks immediate liquidity. Then, the market seeks durable protection. Those are not always the same phase. This is why so many people get shaken out of gold at exactly the wrong moment. They expected phase 2 to arrive cleanly without first passing through phase 1. Markets are rarely that polite. A real monetary stress event often begins with a scramble for the most liquid claim in the dominant currency and only later evolves into a broader repositioning toward hard assets as the implications of debt, debasement, and geopolitical fracture sink deeper. That is a dollar squeeze. It is not the end of the gold story. It is often the messy middle. Now let me take you into the fourth mechanism. I call it the sovereign sale. This is where the story leaves the trading desk and enters the hard reality of states trying to defend themselves in real time. The source material points to Turkey and Gulf states selling or being described as selling significant gold reserves in order to support currencies, energy imports, and war-related spending. Whether every exact tonnage claim in the file is perfectly stated or not, the underlying structural idea is sound and very important. When sovereigns need immediate dollar liquidity, gold becomes one of the most saleable reserves they can mobilize quickly. That is the sovereign sale. And it matters because it reveals something cruel about gold's role. Gold is both protection and liquidity. People often remember the first part and forget the second. When a sovereign or a large institution is under immediate pressure, it does not necessarily sell what it dislikes most, it sells what it can sell fastest, and in size gold qualifies. That is why gold can fall during periods that superficially look like they should be perfectly bullish for it. The long-term thesis did not necessarily weaken. The immediate need for dollars simply outran patient ownership. That is the difference. This is also why I tell people not to romanticize every central bank or sovereign balance sheet as if those holders are permanent saints of the gold cause. Number, they are managers of survival too. If defending a currency or funding an emergency requires selling a liquid reserve, they will do it. That is the sovereign sale. And once sovereign supply enters a paper market already under margin stress, the visible price can fall much harder than the public expected. That does not automatically invalidate the metal. It may simply reveal which holders needed immediacy more than conviction. That is a very different reading. Now let me say something even harsher. A lot of retail investors think they are long-term until the market forces them to watch what real long-term holders look like. Real long. Term holders are often still there after a sovereign sale, a margin flush, and a dollar squeeze. Most people are not. They are short-term holders wearing long-term language. The sovereign sale reveals the difference. Now let me take you into the fifth mechanism. I call it the repatriation signal. This is where the story becomes bigger than a single chart move. The source material makes a dramatic point here around France moving gold exposure away from the United States and Germany debating the same direction. Some of the file storytelling around exact motives is speculative, but the valuable core idea is still important when major countries prefer to hold or source more of their gold closer to home, or show rising discomfort about keeping too much strategic metal under another power's custody. That is not a trivial signal. That is the repatriation signal. And it matters because gold is not only an investment asset, it is a trust asset. Where you store it says something. Who holds it says something. Whether states are comfortable leaving it under another sovereign supervision says something. When countries grow more interested in domestic control, local custody, or reserve diversification outside the traditional dollar-centered trust chain, the move is about more than logistics. It is about confidence. The source material pushes this with a lot of force, linking the discussion to older gold repatriation episodes and to the deeper fear that in a more fractured world, strategic reserves should be controlled directly rather than assumed to be available on good faith forever. That is the useful layer of the argument. You do not have to swallow every dramatic flourish to see the important truth. Gold repatriation debates are rarely about decorative inventory management. They are about reserve sovereignty. They are about trust in counterparties. They are about whether the old reserve system still deserves the same automatic confidence it once received. This matters for ordinary investors because it tells you what serious institutions worry about when the world gets less stable. They worry about possession. That is the word, not paper exposure only. Possession. That is why the repatriation signal belongs in this story, because it reminds you that while the public obsesses over whether the price quote is down 8% or 12%, nations are thinking in terms of where the bars are, whose vault they sit in, and whether the old assumptions about access still deserve trust. That is a much deeper game. Now let me take you into the sixth mechanism. I call it the vault signal. The source material points repeatedly to physical deliveries, falling registered inventory on COMEX, and the idea that while the paper market was under pressure, actual metal was still being pulled out of immediately available inventory. It uses that contrast as evidence that physical demand may be tighter than the visible quote suggests. That is the vault signal. And it is one of the most important cross-checks you can make in a market like this. If the visible price is falling but actual deliverable inventory is being drawn down and physical buyers are still taking metal out of the system, then the story is not as simple as gold is weak. The story may be that paper holders are being flushed while physical holders are quietly absorbing. That is a huge difference. This is why I never trust the visible move by itself. I want to know what is happening underneath it. Who is taking delivery? Who is demanding metal? what is happening to registered inventory, what is happening to physical premiums elsewhere. That is how you stop being a prisoner of the quote. The quote matters. It is not enough. The source material is essentially trying to say that the paper washout and the physical pull are two different languages speaking at once. That is a useful way to think about it. Exactly. One language is leverage unwinding, the other is possession concentrating. The first language dominates headlines, the second language often dominates long-term consequence. And if you confuse them, you will keep selling what stronger hands are willing to absorb from you at a discount. That is the vault signal. It asks one brutal question: when the market got disorderly, did real metal become easier to obtain or more actively pulled away from easy availability? The answer matters. It matters a lot. Now, let me take you into the seventh mechanism. I call it the eastbound flow. This is where the market stops looking purely Western and starts looking like a transfer of conviction. The source material spends meaningful time on Chinese demand, Chinese ETF resilience, Shanghai activity, and especially the ability of major Chinese insurers to allocate a small share of giant balance sheets into gold. Again, some of the rhetoric in the file is theatrical, but the structural point is powerful when large pools of capital in China, along with central banks more broadly, remain biased toward gold, while Western paper positioning is being flushed. The center of demand can shift eastward in a way the public underestimates. That is the eastbound flow. And it matters because demand is not a single crowd. The same week that one set of investors is being forced out, another set can be stepping in for very different reasons. Western leveraged holders may care about margin, short-term rates, and the visible, quote, Asian institutions. Reserve managers and strategic buyers may care more about long-run reserve diversification, currency distrust, and physical possession. Those are not the same incentives. That is why a price break can be interpreted so differently across regions. One side sees failure, the other side sees an entry window. The source material is especially insistent on this asymmetry, arguing that while North American flows weakened, Chinese interest remained more resilient and policy changes there could create additional support beneath the market over time. That is the key. The future buyer is often not the same as the past seller, and if you do not understand that, you will keep reading the market as one undifferentiated mass. It is not. It is a layered competition between different time horizons, different balance sheet strengths, different political systems, and different reasons for owning the same metal. That is why I call it the eastbound flow. Not because geography itself is magic, because reserve behavior is shifting, and reserve behavior is one of the strongest signals in the gold market. Now let me say something harder. A lot of retail investors keep asking whether they should think like traders or like long-term gold owners. That confusion destroys them. If you are structured like a trader, fine, then trade, but do not speak the language of reserve accumulation while acting with the emotional fragility of a leveraged speculator. That is incoherent. The eastbound flow matters because it forces you to see the difference between those two temperaments. Now let me take you into the eighth mechanism. I call it the weak hand flush. This is the point where everything joins into one cycle paper leverage. Margin hikes, dollar strength, sovereign selling, physical withdrawal, reserve repatriation signals, Asian accumulation, all of it collides in one period. The weak hand flush is what happens when the visible market becomes violent enough that everyone who owned gold for the wrong reasons gets stripped out before the longer. Cycle holders take fuller control of the next phase. That is the flush. The source material essentially builds its whole drama around this sequence, saying the public saw gold crash while the stronger structures underneath were shifting toward more concentrated and more strategic ownership. Beneath the aggressive presentation, that framework is the real value in the document. That is why I am not interested in the cheap version of the conversation. The cheap version says either gold failed or they manipulated it. Both phrases are too lazy by themselves. Sometimes there is structural pressure, sometimes there are rule changes, sometimes there are incentives aligned in ways that punish smaller players, sometimes there is obvious unfairness in who can survive the move. Fine, the richer question is still this. What did the move accomplish? Who was forced out? Who gained access? Who strengthened custody? Who improved position? That is how adults read a market. Not by stopping at outrage, by following the transfer. Every serious market event is a transfer event before it is a moral argument. That is true in real estate. It is true in credit. It is true in stocks. It is true in gold. The weak hand flush is not the end of the story. It is the chapter where ownership gets redistributed from hands that needed calm conditions to hands that were built for disorder. That is the whole point. Now, let me make the identity flip explicit. Most people think owning gold means having the right opinion about gold. That is too small. The real issue is whether you are holding gold in a structure strong enough to survive the sequence that always seems to arrive when the public is most certain the thesis should be obvious. That is the flip. A spectator asks whether the price moved the right way this month. A stronger owner asks who was forced to sell and why. A spectator watches the chart. A stronger owner watches the paper market, the vault, the dollar, sovereign stress, and reserve behavior together. A spectator wants immediate confirmation. A stronger owner wants structural understanding. Those are different minds. The market treats them very differently. Now let me bring the operating system together in plain language. First, stop assuming the visible paper quote tells you the whole truth about the gold market. Second, understand margin structure before you use leverage in a market that can be flushed mechanically. Third, learn the short-term role of the dollar so you do not confuse a liquidity squeeze with the death of the long-term thesis. Fourth, watch sovereign and central bank behavior because their actions tell you more than public slogans. Fifth, pay attention to custody, repatriation, and reserve sovereignty signals because possession matters when trust weakens. Sixth, monitor physical market signals alongside paper market stress. Seventh, decide whether you are trading swings or building long-term ownership and then make your structure match that decision. Honestly, that is the operating system, not panic, not blind faith, not slogan worship structure. Now let me put the blade into this as cleanly as I can. Gold did not get smashed because the long-term case for gold suddenly died. It got smashed because the first phase of this kind of shock was a paper flush driven by leverage, margin pressure, dollar demand, and forced sovereign liquidity needs while stronger and more patient hands used the disorder to improve their position in the real metal. That is the real story. And if you remember nothing else from what I said, remember this. When the world gets disorderly, the public keeps staring at the price. The strongest players keep asking who is taking possession. Learn that difference. And one day you stop being one of the people shaken out by the move that was never really meant for you. You start preparing for the transfer beneath it.